The Egyptian economy entered 2023 with significant pre-existing challenges arising from the fallout of the Russia-Ukraine war, including elevated inflation, depreciating currency, and considerable foreign currency shortage. But optimism regarding structural economic reforms was relatively high as the government ended 2022 with the finalization of the $3 billion IMF program that focuses on implementing a flexible exchange rate regime, enhancing private sector participation in the economy, and continuing fiscal consolidation measures while increasing social spending. Accordingly, in the first quarter of the year, the official exchange rate depreciated by 20%. The government reactivated its privatization program in line with the state ownership policy document, and the monetary policy was further tightened to anchor inflation expectations. However, the reform progress didn't last long, as the official exchange rate was refixed at 30.9 Egyptian pounds per United States dollar since March 2023. And with slow progress regarding the sale of state-owned assets and the widening of the parallel market rates premiums, the IMF program was stalled with the first and second reviews scheduled for March and September 2023 delayed. As a result, investors' sentiment and pre-2023 optimism started to fade quickly, with the foreign currency shortage intensifying as a result of the rising external debt service payments and limited borrowing space, severely impacting businesses, economic activity, and raising inflation to record highs due to widespread supply shortages resulting from imports bill compression. Real GDP growth averaged 3.2% during the first 3 quarters of 2023, significantly lower than the long-term trend and mainly driven by better net export position due to the significant decline in imports. Workers' remittances were more channeled to unofficial channels, decreasing on an annual basis by 36% or around $8.2 billion during the first 9 months of the year, contributing to further foreign currency crunch. That has been coupled with sharp reduction in natural gas exports as domestic production declined by around 11%, global prices normalized, and domestic consumption increased, leading to persistent electricity cuts. Then comes the devastating Gaza war, with its significant humanitarian crisis that has further added to the already existing imbalances in Egypt's external position. Starting with natural gas imports that declined considerably at the beginning of the war, leading to slower recovery in Egypt's LNG exports and further electricity shortages. That has been coupled with immediate negative implications on the tourism sector, which was recovering well from the pandemic lows and ended the year with all-time high tourist arrivals of 14.9 million. However, the fourth quarter of 2023 registered lower than the government's target for tourist arrivals by 600,000 due to regional security concerns. That was followed by another external hit to Egypt's stable foreign currency income, with the Red Sea security risks impacting Suez Canal revenue significantly. Major shipping companies started diverting their vessels away from the shorter route, passing through the canal in favor of the safer, albeit longer, Cape of Good Hope route, particularly as attacks on vessels increased following Western strikes on Yemen's Houthi targets. Such implications have further worsened the country's external position, with Moody's and Fitch downgrading the sovereign rating twice in 2023 and Standard & Poor's downgrading once. Moody's also changed Egypt's outlook to negative again at the start of 2024, signaling that an additional downgrade is likely if the external position and debt affordability metrics don't improve. Egypt's overall budget deficit is expected to widen to around 7% by June 2024, compared to 6% a year earlier, ending 7 consecutive years of improvement in the fiscal balance, mainly due to spiking interest payments, which are expected to account for almost 2/3 of total government revenue, both tax and non-tax, in the current fiscal year. Coupled with increased spending on social protection measures, including food subsidies, pensions, and Takaful and Karama cash subsidy program. The government's total debt as percentage of GDP also increased sharply in previous fiscal year to cross 95%, driven by inflated foreign debt following currency devaluations, while the government targets 91.3% by June 2024. Foreign borrowing has also been very costly, considering the sharp monetary tightening cycle in advanced economies throughout 2023 and Egypt's very high yields in international debt markets and its lower credit ratings. However, the government was able to issue a cumulative of around $2.5 billion through a sukuk issuance and local currency-denominated bonds in the Chinese and Japanese markets, leaving Egypt's total external debt at over $164 billion by September 2023, though the pace has fairly moderated last year. Despite that, Egypt's external financing needs remain very high and increasing, considering the rising external debt service payments that amount to around $30 billion in 2024, after excluding possible rollovers and uncleared backlog. That is leading to further reduction in necessary imports, spiking parallel market rates and commercial banks, imposing cumbersome restrictions on foreign currency transactions. All of that is fueling speculation and further complicates the macroeconomic outlook. Solutions exist, but the costs of rebalancing the economy are increasing high so long as decisive monetary, fiscal, and structural reforms are not taken in a timely manner. Underlying fundamentals are still attractive to investors, further supported by the government's clear focus on attracting foreign direct investments going forward in multiple sectors, including green energy, logistics, tourism, ICT, banking and insurance, healthcare, among others, rather than relying on hot money inflows. External shocks, including the turbulent regional geopolitical situation, will likely not go away quickly, and hence it is crucial to strengthen the resilience of the economy going forward while putting it on a recovery path supported by a deep reform process.